everyone, it's Gene Ahrensberg for Got Gold Report again. This week we had gold up a little bit, 1.2%, closing at $1,662 and change. Silver was down 1.3%, closing at $31.24 after attempting a break. It attempted the break, but there was all kinds of bidders there, so it didn't break. This is the daily silver chart, and you can see right in here, you can see where the trading tried to break down out of the Fibonacci 50% to 61.8% retrace box. It actually hit that little trend line down there and bounced right back up into the box and is now moved higher. Let's take a closer look. This is the chart for SLV, and we're using it as a proxy for silver. Notice the gap down there on the 20th. Also notice that on Wednesday we had that sell down. Right, that's the day after the COT report, and it sold down hard here early in the morning and then reversed and actually finished strong, and then we see a little follow through here, but it is on somewhat less than exciting volume on the follow through. Let's not look a gift horse in the mouth. That's still pretty impressive action for silver. What I think is interesting is that it wasn't just the metals that had a reversal looking move on Wednesday. Let's take a look at some of the miners, or rather the indexes. This is the short-term volume candle chart for the Market Vectors Junior Gold Miners Index, the GDXJ. And you see we had that same gap down, and then we actually put in a double bottom with the GDXJ and a nice recovery on the 25th. Moved back up, across the short-term trend line that we use. And it's nice to see the trading back up above that trend line. That's a hint of a reversal. We can't call it confirmed yet, but it looks better. Let's take a closer look at gold. Now this is actually GLD, and it's that same volume candle time period. And I know it looks choppy, but we had that big attempted sell down back on April the 3rd. Gold refused to break back then, and it's been trading sideways ever since. It's just basically looking sideways. What we're hoping for and what we're looking for is a breakout out of this pattern. This is the subscriber gold chart. Once again, we've got gold correcting back into the Fibonacci box here, actually trying to break down out of it. Could be a head fake here and then more consolidation, and now we're trying to get back out of it. We've got resistance, obvious resistance around 1680. And we've got pretty good looking support down around 1620, call it. Our attitude is that since we already have physical gold, we're willing to wait for a substantial break. Maybe something hits the market and knocks it back down into this area down in the green. Down here we would feel a lot more comfortable starting a new short-term trading position for gold. I'll tell you though, I have a high degree, or I should say, I have little confidence that we're actually going to get that shot in the green. Things look to be firming up, and I mean from a COT point of view, as well as the fundamentals that are going on in the market, the increase in purchases of gold by China through Hong Kong, the QE by Japan. Japan just said that they would spend another 10 trillion yen on QE. The IMF just got pledges for 430 billion euros added to the QE that's going on over there. I know they don't call it that, but that's what it is. You got Russia, Turkey, Mexico, and I think some other central banks that are all buying gold. Our friend Eric Sprott said that China has imported 436 tons of gold over the past 8 months, and all the central banks combined imported 430 or bought 439 tons in all of 2011. The point of all of that is that I think that there's a pretty good bid on for gold at any time it dips now. With all the morose sentiment, with all of the things that have been working against gold, it's not a miracle that it hasn't broken down. It is a signal. Here we are back on the subscriber pages. Let's take a look at a couple of charts. First, let's go to the CDNX, the Canadian Venture. Now, the reason we have this big green box here is because we think that could represent some substantial support, maybe even overwhelming support. And the way we get there is that this formed support back in the pretty good correction back in 2010, was the place where the huge sell down and capitulation of last October ended up. It's also where the big sell down that started back last March found support for that January bounce. So this box has shown us that this is an area to look for support. It's not guaranteed. That doesn't mean we can bet the ranch that it's going to be support. But I think it is a better than even chance that this is where we're going to find support for the companies we call the little guys. Now remember, this huge correction that we see here would have been the largest ever correction for the CDNX, if not for the gigantic plunge that we saw in 2008. So I think the fact that we're coming back down to retest that now with this horrible sentiment that we've seen for the small miners is just, I think we're getting the second test. This past week we got down and tested that downtrend line again, and we've bounced a little bit. It's certainly not impressive yet, but we have seen a bounce about where we expected it. And if you look down here at the volume, you can see that it was actually on higher volume. Now, part of that higher volume came in the beginning of the week when the selling was going on. Like, once again, let's don't look that gift horse in the mouth. That's higher volume on the reversal. Now, you would think these companies have been beaten to a pulp, and so many of them are just dirt cheap. I mean, there's a lot of room for improvement here. Let's look at another index that tracks the little guys. Let's look at the GLDX index. That's the Global X Gold Explorers ETF index. Boy, is that an ugly chart or what? But notice, please, we almost put in a downside exhaustion gap and then outside reversal. Almost. The close was just barely under the previous week's high, but that's pretty close. And I may be just trying to put horns on a doe. That's a Texas expression for seeing a buck when there isn't one. It means seeing something that you really want to see, but it isn't really there. I may be doing that, but that looks pretty encouraging. It must look like a pond to a guy who's been crawling across the desert. And if it is, if this is the reversal that's getting underway, it's about time, I would say. And once again, this possible reversal is it's the tallest volume bar in the chart, except for way back right after this index got started back in November of 2010. Now we're jumping to the Commitments of Traders report for silver. And notice that the large commercials have gotten down to just 22,353 contracts net short. They actually reduced their net short positioning by 4,144 contracts on an 86-cent down move for silver Tuesday to Tuesday. And with the open interest only going up 877 contracts week to week, that knocks the relative commercial net short positioning for silver futures all the way down to a really bullish looking 18.3%. And trying not to overthink the commitments of traders, what this is telling us is that the people who have to hedge silver are not in the mood to hedge it. They're in the mood to get smaller with their net short positioning. In fact, it's so small as a relative percentage of the open interest as to be nearly at the bottom of the chart. I'll show you that in just a second. This is the chart for the nominal LCNS for silver futures. LCNS is just the combined large commercial net short positioning, and at about 22,000 contracts, we're at the bottom of the historic limits of when the hedgers are just not willing to increase their net short positioning. Now the flip side of that coin is that the speculators are not really excited about silver. They're not trying to buy a bunch of long contracts. But when you think in contrary terms like we do as vultures, and you see that the hedgers, the people whose job it is to hedge metal inventory in any number of ways, when you see that they're not willing, or they're not trying to increase their net short positioning, that tells us that they're not thinking that silver's about to crater in price. To the contrary. And if you think about it, the propensity of the hedgers to increase their net short positioning increases with their perception of where if they think the price of silver is about to fall. We like to compare the nominal net short position with the total open interest. We call that the LCNS TO. Let's take a look at that chart. And you can see it's also at a very low level. Low, when you see the blue line on this chart down near the lower third of the chart, or even below it like it is now, that is contrary bullish. And if you look back in time, here for example, that corresponded with a low for silver. This one corresponded pretty close to a low for silver. This one, same thing. This one, same thing. So when you see these dips in the LCNSTO and they get way down on the chart, you have to start thinking, well, if the hedgers are not excited about hedging their metal, it means two things. It means that a great deal of the speculative interest has been bled out of the market, and it also means that the hedgers, they're not looking for lower silver prices, or at least not materially lower silver prices. Because if they were looking for materially lower silver prices, they would be increasing, not decreasing their hedges. And right now, the hedgers are getting the heck out of Dodge on the silver short side. Let's look at these same two graphs for gold. Now, first of all, the commercial net short positioning for gold fell by 8,800 contracts on just a $7 reduction in the price of gold. That's for the April 24th report. And this is a pretty low level for the commercial net short positioning. Notice that the open interest for gold futures has fallen now is that 8 consecutive weeks? I believe it is. Now, typically a falling open interest for gold is bearish, because it means that there's less speculative interest going after gold futures. But that only works to a point. I mean, you'll go down until it stops, and at some point it's going to stop and it's going to reverse. And notice also, while we're here on the table, that we're back down to 42.3% for the relative net short position. That's a pretty low level for gold. Now, you may have noticed on the front page of the blog, where we put up the closing table for the week, that the open interest had started to tick back up. By Thursday, it was back up to 405,000 contracts. So we may have seen the reversal for gold. We may, underline may, have seen the reversal. Let's take a look at the chart. This is the nominal commercial net short position for gold, and you can see it's back down to what's been kind of the low ebb for the LCNS for the last 3 years. As the price of gold goes higher and gets up close to where you see these highs here, you'll see that the LCNS typically goes higher to answer that. That means that the hedgers feel more comfortable hedging when gold goes higher, and they lose that confidence in hedging when gold falls off. What's important to us is we've gotten back down to the point that has corresponded with lows. Now, this is the LCNSTO chart for gold futures, and you can see that we're at around 42%, which is it's close to the neutral zone, or what I'd call the neutral zone. It's actually slightly bullish. When we get to the high 30s, that's starting to look pretty bullish, and once it gets over about 50% these days, that's starting to look a little scary. But if you look back to the table, when you see the LCNS down at 167,000 contracts, in other words, the large commercial net short, what that's telling us is that's a low level, by the way, compared to 245,000 contracts just on February the 28th. That means there's an enormous amount of firepower that's sitting on the sidelines that hasn't been fired at gold. So back to the 3-year gold chart. We're just about out of time, so we've got to sew it up here. We've got a couple of stops to make before we do, though. The trend for gold is higher. We think that it is breaking out of a large multi-month pennant formation. It's come back down now to almost retest the pennant. Now would be the time you would expect to see a breakout up or down from this Fibonacci box that you see here. And with all the central bank buying and the money printing that's going on, it wouldn't surprise me one bit to see gold break north from here. It would actually be pleasing to me if it would come back down to the green, though, so we could initiate a new long transaction. Do I think we're going back to the green? No, not really. I think we're going higher. And so, friends and fellow vultures, we're back to the CDNX chart. We may have a bounce going on with the precious metals. We may have a bounce that's trying to get started for the junior miners and explorers as well as the big miners, all conditioned on the word may. But whether the bounce is this one, or we've got to wait just a little longer or a lot longer, our duty is to build the largest position we can in the small junior miners and explorers that we want to game, using the resources that we have allocated to them, and then to hang on until things get better. And that's exactly what I intend to do. It's what I've been doing for over a decade with the small junior miners and explorers. I recently sold a little of my gold so that I could be in position to take advantage of any more of these ridiculous low volume panic spikes that we've seen just recently. And by now, the folks that are interested in that kind of thing know which ones we're talking about, because we're putting the notations right in the charts very shortly after we make moves. And you'll find all of those Vulture Bargain and Vulture Bargain candidates of interest charts right here on the subscriber pages. So that's it for this week. Thank you very much for listening and for subscribing to Got Gold Report. We're very proud to have you. When you go to the subscriber site, don't forget to check out the report section where we put things in there from time to time, as well as the recommended video section. And we just put a brand new one in there. Thank you very much. Goodbye for now.
He has no friends to help him now.